Hello friends, last week in my video I told you that the banking space was likely to bring down the broader markets, and look what happened. It's nothing short of contagion. I also told you in my Telegram channel, a free Telegram channel post, that Reliance Industries was another worry because of its sheer weightage of over 10% in the index and a head and shoulder formation. And because of the low impact cost, because of the low bid and offer spreads, institutions would come out and hedge and or short Reliance against all their other long positions. And look what happened. Banking is not a space where you'd like to be, and I've been warning you since many quarters that interest rate sensitives, banks, NBFCs, companies that are dependent on EMIs will do rather badly where stock prices are concerned. In this video, I have a special segment about whether banking is going to continue to fall where stock performance is concerned and what is the outlook of the broader markets. But let's now jump into the market roundup window on your screen, and what you are seeing is that the fall was led by banks. The bank Nifty was leading where declines are concerned. The Nifty brought up the rear and the US dollar index fell. The fact that our markets fell in spite of a weak dollar highlights the underlying sentiments which are nervous. Normally, emerging market indices, including India, should have rallied if the dollar fell. But expectedly, gold and silver rose. Silver outperformed gold, and those of you who've been with me for some years now would have recollected how I had given targets of 60 and 65,000 per 10 grams of gold and 80 and 85,000 rupees per kilo for silver. Silver has not yet gone there. Gold is approaching 60,000, and 65,000 could be delayed. Instead of 2022, it could come in 2023. But you're much better off in bullion than you are with other areas of financial markets. Crude oil and natural gas fell. I have been telling you across my social media accounts there is no super cycle. And I have been maintaining that since 2021, and here you are. The US dollar index fell 77 basis points, but the USD INR rose, which means the dollar rose against the rupee and the rupee has weakened a bit. Indian 10-year benchmark bond yields fell 6 basis points, which means bond prices went up. This tells you that there was some amount of flight to safety. NSE lost a little under 2% in market capitalization. MWPL went up, which is routine, and the US markets saw the Dow Jones Industrial Average lose marginally, whereas the Nasdaq and S&P 500 gained. Coming to our in-house indicators, the MWPL, which is the market-wide position limits, the extent of limits utilized by the traders as compared to the total limits allowed by the regulator, has risen along routine lines in the third week after expiry. This figure will peak out, which it does before the expiry of every month. And this is a different kind of a month. It's the financial year end. The fact that the third week is seeing MWPL of 29.77, whereas the previous month was 30.65, tells you that risk appetite was lower. I'm not surprised because the markets were down. Now take a look at the index and stock futures turnover. These are cumulative figures for 3 derivative cycles, so it's March, April, and May. Index futures turnover has really jumped, whereas stock futures turnover has risen mildly. Even if you account for the fact that the week prior was a shorter one due to Holi, and the turnover may have been marginally lower in the comparative week prior, still the spike in turnover is taken it to almost a 20-week high where the indices are concerned. That tells you, and I quote what I said in my previous video, due to the turnover, the market seems to be well oiled on the road to declines. That means the slippery slope is well oiled for the markets to fall faster. Individual stock turnover is down because its stocks are a lot more volatile as compared to indices. So traders normally stick to indexes. Now, for the NSE advanced decline ratio, this is the second consecutive week the Nifty 50 logged declines, and the advanced decline ratio fell back below 1 to 0.71. Now, this is the fastest indicator after the price itself to tell you which way the winds are blowing. The fact that for every 71 gainers, there were 100 losers tells you that one marshmallow traders, the intraday players, lacked the courage to buy. This is not really a very great sign. Now for the basis. Basis is the discount or premium prevalent in the futures compared to cash. The basis across both indices rose in spite of the fact that we are in the third week after the expiry of the February series. Why did the basis rise? Because there was short covering seen at lower levels, primarily in the last two trading sessions of the week, Thursday and Friday. So the basis has risen. But rising basis triggered by short covering can only slow down the decline. It takes pure fresh buying to pull the markets higher. So we haven't seen big ticket buying come in yet. Now, for our in-house exclusive indicator, the impetus which you have been witnessing since April of 2021. You've depended on it, you found it to be reliable, and I've received a lot of positive feedback on it, and look at what it's pointing at. Quite simply, the impetus across both indices has jumped to highs. What does it tell you? Impetus is an indicator that measures force. Since it's an exclusive indicator, it's not found elsewhere. Now, the fact that the markets have fallen and the impetus has risen tells you that there was a great deal of force in the selling. And that is not exactly good news. So we need to keep a watch in the coming few trading weeks. Now for the LWTD indicator, which you have been witnessing and using since the last 1 year. What it basically tells you is that the index has lost in price, and the LWTD, which was in the positive zone in the prior week, has fallen into negative zone last week. Now this again is an exclusive in-house indicator you won't find elsewhere, and this tells me that even at lower levels, short covering might be a little less compared to the previous week. That means either the bulls come out and give fresh buying support, or the markets are going to slip and slide a little more in the coming week. Now friends, our in-house indicators done, I come to the bond market, which forms the crux of the entire banking problem. Rising coupon rates is something I have been warning you since 2021 across my social media accounts. And rising coupon rates is what has triggered the banking crisis. I have put up posts on my Telegram channel, and the last one that I have put up before recording this video is about how Wall Street Journal is now saying that at least a dozen or more banks in America are likely to have systemic problems, just like Silicon Valley and Signature Bank had. So it's not over yet. What does it mean for bond yields? It tells me that there is a possibility, just like the European Central Bank raised rates by 50 basis points, the possibility is that rates haven't peaked out yet. Should you continue to ladder? Yes, you should continue to ladder. Should you keep a few check leaves spare because there is more to come? I stand by what I posted on my Telegram channel last night. Do keep a few check leaves spare, because I'm going to share with you a couple of investment avenues in the sovereign guaranteed, central government guaranteed investment space, with higher than average return for you, but these windows will be open to you only after 1st of April 2023 because the legislation has not yet come into effect. So yes, I continue to ladder and I keep the powder dry. I'm keeping some money spare for averaging down or laddering down my sovereign investments. Now, what you are seeing on the weekly chart of the Indian 10-year benchmark bond yield is that since peaking out in May 2022, rates have been making lower highs. For the interest rates to actually go out there and get into a bullish orbit where yields are concerned, you probably will have to see Indian 10-year benchmark bond yields go above 7.52 or 7.54. That shouldn't really stop you from laddering. What if yields were to fall? I would start to rethink only if yields fell below 7.20 or 7.18%. I'm talking of Indian 10-year benchmark. Even then, remember I told you some windows are opening for you after 1st April. Even then, your laddering yields will not really impact you too much. As a matter of fact, you're going to make higher rates of return. So remain assured on that front. Friends, the bond market's done. I now come to the Bank Nifty, which bore the brunt of selling. It fell 2.19% on a week-on-week basis. It fell on 3 out of 5 trading sessions. As you can see on the daily chart on your screen, the price has bounced back from its previous swing support, which I have marked with a dotted trend line. But the price remains below its month-long moving average, and the moving average itself is pointed downwards. That tells you that the pressure remains in place and rallies will remain pullback rallies in nature unless and until you actually see the Bank Nifty trade above the 41,840 level. Let's take a look at the weekly chart. The 38,759 swing high made in April 2022 is where the Bank Nifty took support last week and pulled up higher. Now, the chart pattern itself suggests a bearish candle with a fairly prominent wick or a shadow. That's because Thursday and Friday, the markets pulled higher. Otherwise, the bearish candle's body would have been significantly bigger. But the price remains below its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook for the Bank Nifty is nervous. The index is pointing lower and the 25-week average also has tilted mildly lower. It's not out and out bearish, but it's mildly lower. That tells you if the average was to turn bearish and start falling, the Bank Nifty bulls could be in for some amount of pressure. You could sweat under the collar. Now, in the week before last, I told you that this index was ranked at number 2 on our in-house statistical beta list of counters that were most volatile. Last week, it remained at number 2, which is a challenge because high volatile counters are not something every retail trader can tackle easily. Last week, I advocated a range between 41,950 on the upside and 39,000 on the downside, which held perfectly well in spite of all the volatility. In the coming week, I expect a range between 41,125 on the upside and 38,075 on the downside. Friends, I suggest we continue to trade light because volatility is likely to see the market being thrown all over the place, especially in the last 10 calendar sessions of the month, because mutual fund industry is typically interested in boosting NAVs. Whether they would want to come and do this this year, it remains to be seen. But volatility is likely to remain elevated. So let's be careful out there. Friends, the Bank Nifty done. I now come to the Nifty 50, which fell 1.80% by logging losses on 3 out of 5 trading sessions. As you can see on the daily chart of your screen. What is immediately apparent is that the Nifty has fallen below the bold red falling trend line which connected the tops made by this index in October 2021. The previous swing support of 16,793 has acted as a rough and ready support for now. The price is below its month-long moving average, which tells you that the short-term outlook is weak. The average itself continues to remain pointed downwards, which tells you that buy and hold Nifty traders are underwater where mark-to-market payments are concerned. Switching to the weekly chart, what you are seeing is that this index has closed below its 25-week exponential moving average for the fourth consecutive week in a row. The moving average itself is pointing lower. It's just begun its decline. If it accelerates, this could tell you that the declines might just deepen. Here you can see the swing high of May 2022 at 16,793 acting as a rough and ready support. If it is violated, further downsides cannot be ruled out. The 18,115 level, which I have been talking to you about since at least 2 months as a resistance, is getting more and more difficult to cross over in the absolute near term. In the week before last, this index was ranked at number 8 on our in-house statistical beta list, and it jumped 3 notches. It's now at number 5 on the volatility rankings. Not a good thing to happen, because high volatility can only make trading difficult for an average retail trader. Last week, I advocated a range between 17,875 on the upside and 16,900 on the downside. Admittedly, our support was violated because the Nifty made a low of 16,850, which is a full 50 points below where I thought the fall would stop. But to be fair to our systems, I did tell you last week that I expect the ranges to be violated because of the extreme nervousness. And 50 points on the Nifty, that too for an intraday fall rather than a closing basis fall, is on a base of 16,900 odd, a small figure to bear. In the coming week, I expect an upside of 17,600 and downside target of 16,600. Let's continue to trade light and look at Reliance for guidance on the Nifty. Friends, now for the last bit of statistical analysis of where the retail risk appetite lies. Take a look at the daily chart with a look back period of 20 days. What you are seeing is a sky blue line which tells you that stock options turnover just rose on a week-on-week basis. So traders were willing to take a higher risk. Don't forget that the turnover has risen last week. Now, stock futures turnover, which is indicated by olive green line, has also risen on a week-on-week basis, as has the index futures turnover. So where has the turnover fallen? Turnover, as you can see on this chart, has actually fallen on index options segment. Now, this is the lowest risk, relatively speaking, of course, because indices are less volatile than individual stocks, and index options are less difficult to trade as compared to other futures, both stock and index futures. So traders have actually started taking higher risk and shorted the markets well. That tells you that the downsides continue to remain well oiled. Friends, now I come to what I would do in the coming week. Now, allow me to be a little happy out here. I have been telling you that I would bet on theta decay on interest rate sensitive stocks and a few cyclicals. That's played out pretty well for us. We basically, as I told you in my videos about whether US banks are weak and how much more weakness you can expect You can check that video out. It's in the description below this video, in the pinned comment below this video. And I told you that theta decay on interest rate sensitive cyclicals, which yield anything more than 21% per annum, is something we are always ready to take. The higher, the better. Of course, as long as the risk containment measures or risk metrics like Jensen's measure and Traynor ratio are justifying taking that leap, we are willing to continue to take that leap on interest rate sensitives. I will also continue to seek short selling opportunities in the commodity space where energy is concerned, both crude oil and natural gas. I have been constantly telling you that I debunk all theories about super cycle in the energy space and the commodities market. Look at crude oil. It's fallen by almost 50% in the last 9 months. And where natural gas is concerned, it's fallen by 80% in that period. So I don't want to talk about what to do with the super cycle theory. You're your own best judge. As a trader who likes to play and go with the flow, I still feel equilibrium is on the downside. But I would seek out optimal short selling points and not just go short blindly. I have not yet initiated my fat tail risk hedge in the foreign exchange space. I'm still waiting, and I will update my Telegram channel whenever it's time to do so. Friends, I promised you that I would record a short segment about whether I'm still bearish on banks. Now, on my free Telegram channel, I've updated a link just before recording this video, which says economists in the US are now saying that risks faced by Silicon Valley and Signature Bank are likely to be faced by at least a dozen more banks. I think it's a very conservative estimate. I think this risk will be run by many, many more banks for the simple reason that not many of these guys were planning for higher cost of funds, as you and me have been, because I've been discussing that fairly often in my Telegram posts, in my editorials, and very short updates on my social media due to the word count limitations on Twitter, of course. So Telegram happens to be the flag bearer of our research views and materials that I put up out here. So banks tend to be interlinked. Now the problem with SVB is, or Silicon Valley Bank, is that it was offering higher rates of return, and therefore other banks had parked their deposits with SVB. You've only seen SVB fail. The banks that had deposited their money with SVB are likely to have a ripple effect being felt by them over a short period of time. So that impact is yet to come. Number two, if the US Federal Reserve is to increase interest rates in its forthcoming meeting, that would tell you that on one hand, they are injecting money into the beleaguered banking space, and at the same time, they are raising interest rates, which means save the beleaguered banks but continue to raise rates. If that happens, money will fly out of the system and flow towards big banks and big players. The small and medium players in the banking and in the business space will feel a cash crunch. Now, that is something not too many people are planning for. That, in my humble opinion, is a mistake. Even if the US Federal Reserve was not to increase rates but continues to bail out the beleaguered banks, it would still mean sucking out liquidity from the economy to help banks that are floundering. The small and medium business owners are still going to find arranging finance a little more difficult, and a little is a very subtle understatement. So that will have a cascading or a ripple effect on the job front, on household savings. As I discussed in the video on whether the banking space in America is still weak, it will have an impact on credit card repayments. It will have an impact on auto loan repayments, housing loan repayments, student loans, and let's not forget the junk bonds. These are a nightmare waiting to occur. Because these are very poorly rated instruments and now there is a flight towards safety. As a simple thing to do, just see how gold and silver have risen along with falling stock prices. People are running to the safety of high quality. How long do you think people will stay invested in junk bonds? Or the sovereign bonds of third world countries which have an investment rating which is not really very enviable. So in my humble opinion, the banking problem is not over. It only remains to be seen whether the biggest boys of them all, the hedge funds, the mutual funds, who are vested interested parties to pull up stock and other asset prices by the end of every quarter. And in the case of India, the coming quarter end is also the financial year end. They might come up and boost up the NAVs. The real test will come from April onwards. If the market starts to fall from April, you would have known that the rally, if any, in March was just a temporary relief rally. Let's be careful out there. More on my Telegram channel. Friends, I now come to the most popular segment of this video where I give you 5 stocks which have gained the most amount of impetus on Friday. So you take small exposure, wait for large price moves on Monday, and 5 stocks that have lost the most amount of impetus on Friday. So you take big exposure, wait for small price move, that's for scalpers. This list is valid only for Monday, Tuesday to Friday. This list will be updated only on my Telegram channel. So the list of impetus gainers is led by Astral, followed by Bharat Petroleum, then Motherson Sumi, ABFRL and Wipro. The list of stocks that lost the most amount of impetus is led by Cipla, Adani Ports, Adani Enterprises, Shriram Transport Finance and Bharat Heavy Electricals Limited. Friends, I hope my videos and my Telegram channel, more importantly, are helping you become better traders. I would love to hear from my online family about your feedback and how our work is helping you do better. Also, a request to subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put about here, and help us to reach out to fellow like-minded smart traders like yourselves by sharing my video with your friends and family. I thank you for your patience in being with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Bye-bye.